My name is Mark Berryman. I'm the managing director and partner at Caprock. We are a multifamily office and investment advisory firm. What we're known for is our long-standing history of private impact investing. To date, we have invested in over 90 private impact funds across impact themes and sectors totaling $1.5 billion. And we do this on behalf of our clients, who are ultra-high net worth individuals and family foundations. Now, before I introduce our expert guest here, I would like to set the table about what we're here to talk about today, impact washing. And I know some of you were in the last session where this got hit on a little bit, talking about ESG integration and greenwashing. So prior to the pandemic, we were very fortunate to go to conferences and events in impact investing where we shared lessons of experience with our peers and stakeholders. And you could always count on a session or panel about impact reporting because it's core to mobilizing more capital to impact investing. Impact investors like ourselves and Bain Capital here today, we seek financial returns and impact returns, meaning social and environmental results, often known as key performance indicators. Now, over the last decade, we've been very fortunate to benefit from infrastructure around impact reporting. Rockefeller Foundation, the Global Impact Investing Network, they helped us create things like IRIS, the Impact Reporting Investment Standards, which is a huge database of KPIs, or the Impact Management Project. Despite all of that, and despite the sharing of best practices, impact washing is still a huge risk. And some would say it is probably one of the biggest risks to growing this space. And as we talked about, or you talked about in the last session, is there is a growing backlash against ESG integration. Now, ESG is different from impact investing, and we'll talk about that, but it is becoming more of an issue. So impact washing, you guys heard about greenwashing in the last session. What is that? That's when investors, private equity folks, venture capitalists, or even folks who issue bonds overstate or they falsify the impact results, some sort of social and environmental result. So we're going to talk about this concerning risk, what folks are doing to mitigate it, and we're going to focus in on a private equity player who is one of the first in the private equity world to launch an impact business and what they have done to mitigate impact washing for their business and their strategy. So we are very lucky to have Cecilia Chao today, one of the co-founders, and I should say architects, of Bain Capital's impact strategy, Bain Capital Double Impact. Now, full transparency, Caprock is an investor in Bain. When we were scanning the market back in 2000, this would have been, when we did 2020, we were looking for a private equity firm that had developed the most intentional, thoughtful, clear impact thesis and clear impact framework, and we were very happy with our selection with Bain Capital.
Thank you for that.
I'm going to start out with, I heard the word controversy about 10 minutes ago. Impact washing is a controversy, so I'm going to ask you a gun-blazing question out of the gate. Is impact washing, in your view, let's talk about the industry first before Bain, the biggest risk to growing our industry?
So I would say yes, but I also want to say that I think we can't be driven by our fears. So on the one hand, here we are on sort of social enterprise conference, and we are the leaders. We've been designated a practice leader from Blue Mark. So I want to say that we absolutely believe that you have to have transparency and rigor in your measurements to drive towards those positive social outcomes. That is the essence of what we're doing. So that is really foundational. But at the same time, I want to highlight the other side because on the one hand, you spent a lot of your time at this conference hearing about, yes, we absolutely need consistent, rigorous measurement. And so I think that is a clear mandate. But what also we can't have happen is be driven by our fears, swing the pendulum so far to the other side that it becomes near impossible for mission-driven companies to succeed and achieve their outcomes, or for them to be stuck at measuring output and not measuring outcomes, because that usually is an evolution. Usually you start from measuring some of the outputs that eventually get you to being able to design a third-party study, which is expensive and takes years to design to get to an outcome, to actually test whether what the process, our theory of change, is resulting in the social or environmental outcomes we're seeking to drive. but that if we get too stuck on reporting and perfection and measuring consistency and historical comparability, which of course we want, but we also want that evolution to get us to outcomes. And so on the one hand, I absolutely want us to take away that measurement reporting is an imperative to prevent. On the one hand, it's awesome. When we launched, actually, we spent a lot of time trying to define what impact investing was. People literally asked us, is it an investment style? Is it an asset class? Is it a stage? People didn't know what it was. So it's awesome to be here today and 40% growth, as Jin reported, in impact investment, and that you've got greenwashing. Everybody's an ESG or impact fund today. So on the one hand, that's awesome, and we love it. But on the other hand, I just don't want us to lose the plot, what we set out to achieve, which is positive environmental and social outcomes.
Let's delineate a little bit between ESG and impact investing. For us, ESG investing is something that happens typically, and it's evolving, in the public markets, so public equity funds, or in fixed income. We believe impact is in the private market, so real assets and private equity and venture capital. How do you guys delineate the two and how you thought about creating double impact?
I would agree that we think of ESG as risk mitigation, and generally the strategy is still, although actually it's moved a lot more towards positive outcomes, which is something we've also had to evolve, because I think it's a nascent industry, so it's evolving. But in the end, ESG is still primarily focused on optimizing financial returns. So you're managing ESG risks and positive outcomes to drive and maximize financial returns. Whereas impact investing, you are intentionally driving both financial alongside competitive social and environmental returns.
It's going to be blurry over time, and that's why I said that. Can I give an example before we move on? Is venture capital is not the public markets, is it? Well, what happens when a highly social enterprise business goes public? Was that no longer an impact business? An example is a sustainable egg company called Vital Farms. A lot of our venture capital funds invested in it. It had a very successful IPO, and now it's in the public markets. So do we no longer call that impact? That's a question we're going to have to grapple with over time. Or when private equity funds aren't doing an impact fund, but are doing an ESG screen and a pretty good ESG analysis, does that mean they're not impact? They're an ESG private equity? It's going to get very blurry, don't you think?
We have seen that from our start. Bain Capital's vision from the start was lasting impact. So when we wanted to launch an impact fund, many of our firm founders were thinking, well, how is this different? Because Bain Capital was founded on this concept of lasting impact, creating sustainable growth, world-class companies. And so how is our impact going to be differentiated? And today it is even becoming more confusing because people literally use the words impact to drive any kind, even if it's financial impact. So it is necessarily confusing. We are working with a partner currently to help us try to delineate and separate this distinction, because even we within our own firm use the word impact to describe what our traditional private equity does, which also is focused on driving, literally, our tagline, lasting impact. But our double impact strategy is differentiated in that we are underwriting social and environmental returns. And so trying to get to a place where I don't need a paragraph to explain the distinction.
I'm going to unpack that in a moment. We've been very fortunate to have things such as IRIS and IMP. What do you think has been the most helpful in terms of frameworks and metric databases when you guys have looked at the industry, and what's missing?
So there's a lot of great developments, and I think they continue to evolve. I do think things like SDGs creates a common language so we can all talk about which vulnerable populations, which targets, which goals we're trying to achieve. SASB materiality, I think, is critical, and one of the things that I think sometimes is starting to get lost in all of the reporting frenzy. So, on the impact, washing fear, comes a lot of reporting, but missing, if you look at our operating principles for impact management, at the start of that is really understanding what's material. And so SASB materiality is a great framework for really helping have a toolkit and framework to identify for which industries what are sort of the more material items that we should be measuring and tracking. But one of the ones that we've been using from our start is the B impact assessment. So that's early on when we partnered with B Labs to use the B impact assessment. Really, it was still rather nascent. But what we loved about it was its transparency, that literally any company pretty much could go on. It was very nominal fee, and it's 200 questions, and you go through and assess how you perform. But you can see how you perform and see where you didn't score as many points, and they had this threshold of 80 to become a B Corp. We didn't actually require our companies to become a B Corp, but we'd set 80 as a threshold of that would be our goal to get most of our companies above that. We've been excited to successfully achieve that across our portfolio, getting most of our companies up there. Last year, we drove a 60% improvement from our baseline score for new companies, to their year one score, because we've implemented what we call a BCDI toolkit to help companies improve across all of the 5 stakeholder groups on the B impact assessment. But that's a tool that we think is transparent, accessible to every company. I'm sensitive. When we joined, as you know, we were one of the first, literally, we were the first alternative investment platform to enter the impact space. And so I'm still sensitive because we benefit from being a platform, but it is such a necessary, I think, investment style, if you will, of really being conscious about social and environmental. I'm sensitive about doing things that sets a standard that others can't achieve, that is too expensive for other small venture, middle market, single climate funds. I don't want to make certain things a standard that we as Bain Capital can benefit from because we have a large platform, a lot of resources. I want it to be available and achievable for any fund, whether large or smaller, platform or otherwise.
Yeah, you mentioned the SDG, the Sustainable Development Goals. A lot of fund managers will say, oh, we invest across the SDGs. Is that enough in your view? In Bain's view and your view?
So they're close to one and the same, because I definitely push a lot of those views that we've published on our website that we, similar to impact washing, there's, sort of term SDG tagging, which is literally, yes, we did something in healthcare, and so it's, SDG 3, health and well-being. And so we publish what we believe are best practices to take the SDGs not even just to the target level, but to the 169 indicators. So identifying at the indicator level what our company is trying to achieve. And so I think it is a great framework to help test. I don't think it is the only framework one can use, but it is a helpful tool to be a first pass and a good common language that we can easily convey with our LPs. This is what we're focused on, and somewhat already established, globally accepted framework.
I think it is a great guide. And as a limited partner and investor in funds, when folks say, hey, we're just doing the SDGs, for us, that doesn't meet the muster. I'm like, great. My 5-year-olds can mix and match, put the square in the, it doesn't do anything. So if you're doing an SDG, what's coming out of it? Is there an output? Is there an outcome? So for us, yeah, it's a nice framework, but that's just first base, and we won't move ahead if someone can't generate an actual output and hopefully an outcome. The last session talked about regulation, starting first in Europe with the sustainable finance disclosure requirements that are coming in Europe, and I think we're going to see it in the US. Is this good or bad, and do you think this will eventually move into private equity here in the US?
I think it's good overall, however, within limits. We obviously, believe that the markets, are largely efficient and it enables innovation, and there are a lot of things to like. However, there are areas especially in capital markets, that it fails are large negative externalities like carbon. And so in a capitalistic world where we largely optimize for profits, you do have the tragedy of the commons, where carbon impacts large populations negatively, but that without sort of repercussions, carbon tax or whatever, lots of incentives otherwise, it really can create inefficient outcomes when measuring social and environmental. And so regulations can help on that. Defining terminology, we've definitely have a lot of this metrics reporting where even the most basic. And so what I found being in the industry is just fascinating, because it's like from the outside, LPs are asking us for reporting, makes sense, transparency, but it's not that straightforward. Even the most basic metric of number of employees. Okay, so part-time or just full-time? Is that going to include just the W-2 workers? Is it going to include M&A? Is just large M&A, or also include tuck-in M&A? All of these are questions to create comparability. And so, so just like that singular metric, you're trying to do it across 20 companies, that are middle market. For me, I came from our large cap fund to help launch the Double Impact Fund. In large cap, I had, just my compliance and GC team could be like 40 people. In the middle market, the entire team could be 40 people. So it's just trying to be, understand the context, really make sure that we're, a little bit to the beginning, definitely driving transparency and accountability, but also not getting so fearful that we can't drive the outcomes we set out to achieve.
As I mentioned, we were excited about doing a private equity strategy, and at first we saw some large asset managers come into the market, and we were like, nah, there's not much intentionality. Are they just grabbing fees? Is this just to put on the cover of a presentation? And of course, we eventually were very happy. We moved ahead with Bain. But walk us back historically here to the year, when it was 2016, around that?
Really, strategy started back in 2015.
Explain, why did Bain want to create a dedicated impact team, a dedicated impact business? What was the catalyst there?
I think it was, part of it really helped. We had our founding partner, Deval Patrick, two-time former governor of Massachusetts, and he fundamentally believed that there had to be a better way for capitalism. So, he calls it conscious capitalism, and, I even notice on this conference, like capital for good. And in some sense, it sort of begs the question, what was the alternative? We were in the other part, right? Capital for bad. I mean, that's not our intention. That's not where we want to be. And we literally just felt it was consistent with our overall Bain Capital ethos. We were fundamentally founded on this principle of lasting impact, but that even there was this new investment for driving impact with intentionality at underwriting. And honestly, we thought that we could help try and catalyze the market, that there was at that time literally no large platform in the space. And so when I did all of the interviews in the market, talking with folks from Generation, from DBL, all these ventures, bridges, it was everybody wanted us to get in, and it was also very clear that they wanted us to be market rate returns. So it was fascinating, because at the time, literally, it was not clear to many in the industry that was possible. And so when I did all these different interviews, that was like the one common theme. It was probably two. One, they wanted us to get in, because if we did get in, it would sort of help catalyze the market and help validate it. But then we must come in at market rate returns. I think that was consistent with our general beliefs and philosophies, but it was very interesting. And even when we fundraised our first fund, like the predominant question was, can it be a market rate fund? it's very interesting. It's like lovely to be back here now on Fund 2, investing across Fund 2, where nobody asks us that questions because they can see our returns. But literally at the time, it was just not obvious. Everybody thought it would have to be concessionary because of all of this additional requirements to evaluate and filter for social and environmental. But I think as some of the prior panel talked about, it is a better way of investing. I would argue, shouldn't we have better returns because we are doing more comprehensive diligence and driving towards things that are going to make better lasting companies?
We agree on that. And when I mentioned, we were skeptical about doing a private equity fund and not just it being a fee grab, but I thought it was all impact washing. I looked at all of these large-scale funds, and this was 4 years ago before we decided to move ahead, and I was like, I just can't get my head around this. And they're all still out there, and we still see them, but the reason why we really like Bain was your impact framework. And you were one of the architects, and you talked a little bit about what your companies do, but can you explain for the audience here how you guys execute impact reporting, working with companies, analyzing the data, and then communicating that back to folks like ourselves at Caprock, the limited partners, the investors?
So we align our processes with operating principles for impact management, starting all the way from screening our deals using the IMP stakeholder assessment, but ESG diligence questions, from the sourcing and diligence phase. But then I think we are very distinctive in our measurement and management, and then even exit. At least when we compare ourselves using the blue mark verification, I think many have gotten to evaluating the impact objectives. But I think where we have really separated ourselves and therefore got the Practice Leader Award is that in that measurement, management, and exit. And our approach, as we've articulated from our start, was to measure both what the company does, so very specific to the company. So if it's a pediatric dental business largely serving the Medicaid population, measuring those unique access, measuring those quality outcomes. And so that's specific to what the company does. But then, as I mentioned, using the B impact assessment to really measure how the company operates. And so that, for us, was a great transparent tool, accessible for our companies to use, the middle market, where we don't have teams and teams of people, but that literally measures not just ESG foundation, but it goes above and beyond. So it'll measure things like, does everybody make a living wage? Have you set goals on? Have you measured your carbon, set goals? So it not only just establishes ESG foundation, but it goes all the way through to positive outcomes.
And how does that translate back to folks like us?
And so then we use that, as you've seen our reports, we literally share each of our companies' B impact assessment, their projected improvements. We publish our year-end review reports, but also give to our LPs transparently each of those impact metrics. So we have literally for every single company, and we report it online as well publicly, what the company specific metrics, but then also our B impact assessment scores.
There's one company that I love, which is a company called Penn Foster. And I'm going to butcher this, bear with me. But it is a workforce training program, an upskilling program. And what I loved about it was what it is doing for its users, but how you guys report on it, because it gets an output and an outcome. So an output, in my view, correct me if I'm wrong, is when someone takes an upskilling class or course. Mm-hmm. An output would be like, we completed it, we did it, woohoo. That's great, but the outcome to me was, I got a job, and I got a better paying job, and I now have a salary that's 30% higher than my prior salary, and I now have this more income for my family at home. But I just love that company. So correct me if I butchered it, but I'd love to hear any other examples from your funds that are similar to that.
I will give you more examples, but I want to maybe just highlight a few additional parts of Penn Foster that's pretty exciting. I think when you share that example, that's what we started with, was program completions, because when we first acquired the company, that's what we could start measuring. So we measured program completions as a measure of output, but really what we were trying to achieve was improved living wages, salaries for the folks who would take these classes. And so then the next really like 9 months later, we were able to implement a survey, but it was a Penn Foster-led survey, which is still not gold standard, but better to starting to get a sense of salary improvement. And then probably by a year and a half plus, we got to a third-party run survey that said if you took this class and it was third party, didn't know it was Penn Foster, did your salary increase and by how much? And so I think it's a good example on, again, even in the last panel, and I want this information, but I just want you to also be cognizant of the limits, which is historical comparability. I'd be stuck at program completions, which we show you and we will provide. But you really want me to evolve and try to get to outcomes and push for that. And so what I don't want the industry to get stuck at is, I invested in the company, we started at program completions, because the industry wants comparability, I'm gonna give you comparability and give you program completions. I want the industry to push me to get and pay for, it costs me a lot more money to do a third-party study. I want the industry to push me to aspire for that and achieve salary improvements. That's what we're trying to achieve. So I just wanted to pause on that example. But many of our companies start, I think, on this journey through metric improvement. Teachtown is a great example. It's a company that serves the K-12 special education market. They use the ABA therapy, the advanced behavioral analysis, to drive, started from autism and expanded to other special educations. But so we measure number of students, in therapy that we've served, but then also percent improvement in their skill-based, as well as number of hours. But one of the things we're working on right now is designing a third-party study that measures improved skill-based, improved output, and so outcomes. And so, again, that takes us a while to develop and design those studies and literally, investment dollars to pay for. But we're started there with what I think are more output, like number of students served. We try to measure both access and quality, but we're also trying to push our companies, usually during our investment hold period, to get to a study that measures outcomes.
You mentioned, when we acquired this company, and I think that's important to note because you probably have more seats on the board. You're working closer with management. Do you think the Bain approach of ensuring that there is impact at the company level and they're working on impact data back to you, do you think it's easier when you're a private equity fund because you potentially and often have a larger stake than, let's say, just a VC who maybe gets 2% into a company? Are they going to have that much leverage to say, okay, listen, we invested in you because you're a social enterprise and you're supposed to generate these impact results, but how much power, I shouldn't say power, positive influence do they have when it's just a 2% stake, in some cases 0.5 or what have you, but the ability at Bain is you are working very closely with management. Do you think that helps drive impact?
I would say absolutely yes. I think actually on two fronts. First, it is absolutely the influence. So being able to influence both what the company is measuring and how they're approaching it. So for example, every single one of our companies has management bonus tied to impact outcomes. That would be hard to do if you didn't have significant influence. You don't have to have a controlling stake, but it certainly helps. But honestly, maybe a less obvious answer is, it's also, if I have a majority stake, it is worth my investing time to make things happen. If I had a 2% stake, it's actually maybe not so material. For every dollar I invest, 98 goes to other folks in that company. If I own an 80% stake, 80% of it, on the return and equity value creation is coming to us. And so I think the control is like actually both sides. On the benefit, is on some of it is influence, but you don't have to have control. Cotopaxi is a great example. We have a minority investment, but very aligned with the founder. And part of it is literally alignment on vision and bringing capabilities to bear that literally help transform and scale the company. And a lot of times that you're not willing to spend that much money if it's really going to just accrete to other partners.
I love that company. Whenever I see backpacks or people wearing them, like, that's one of ours through Bain. I'm always very, very proud. You mentioned this company called Blue Mark. So Blue Mark, for everyone, is a company that was created by Tideline. Tideline is a consulting firm. Bain has a large consulting business. BCG was here. But in my view, I think Tideline is one of the best 100% focused impact consulting firms in the market. What they decided to do, well, they help a lot of folks create impact frameworks, help people develop impact reporting as a consulting firm. They work with asset managers, foundations. They created Blue Mark. Blue Mark is to be a third-party independent valuation company on impact frameworks and on impact results. And they've now done, I heard last week, 100 impact verifications with impact investors across the world. I was very proud and surprised when I heard Bain was willing to open itself up and be verified by an independent group like Blue Mark. What made you decide to go through that process with them?
I'm surprised you were surprised, but we'll have to talk more about that offline. I think what inspired us to do it was honestly that we continue to strive to be both innovators and leaders in the space. And so every year we try to do new things that are new to the market and test the different approaches to see what we can do to improve our own approach and what we could be doing to innovate if there were areas that we were, that are lacking. And so I think we were one of the first to literally get through, all the way through, articles like Principle 8 on exit. And so where we have had some exits and we created things on our processes, what we call impact covenants, which call it new to market, because we've been one of the first to have impact exits, but that literally the principle is sustaining impact through exit. So when we RFP for bids in our exit process, we ask folks to tell us in that process letter how they're going to sustain the impact. How are they going to augment what we're doing? And then in our SPA and our docs, we specify that you will maintain the governance and processes that we've created, our impact councils, our management incentive bonus. And so these are some of the things that we've done to try to make sure that we're continuing to lead. We hadn't seen things done before. We've also, folks ask us whether we get a lot of pushbacks. Inevitably, like the first time folks mark up the docs, the legal teams from the other side, of course, strike it out because it's new and different. And so, but every single time we sit down and say, hey, this is what it means, this is what it intends, they've left it in. So I think it's like one of those areas where you literally have to, learn from the market, understand where are the areas that could be further evolved and what are the ideas, because they don't exist currently. There aren't, this is a brand new space. There haven't been a ton of impact exits. And so we literally have to brainstorm and think about what is the realm of the possible, and then start to implement those and educate the market as we go.
The reason why I say surprised, and I should say pleasantly surprised, is Bain being such a large asset management company, and maybe there would have been challenges in just approvals, opening up to a third party. I think that's where my surprise came from. We're talking about impact washing, and Blue Mark was created to mitigate impact washing, to weed out nefarious players or posers in the space. Do you think next year there will be 200 verifications? And 3 years from now, 300 verifications. And the way investors are going to look at this would be, if you're not verified, we're not going to deploy capital into your fund, which I think will help get rid of the wannabes and posers. What do you think?
I definitely think verifications will increase. I hope that it won't be a limiter. I think literally, in order to be great throughout the verification processes, you need to have lots of structure, organization, and processes. And I believe that smaller, newer funds are not going to be as great at that. I think that they're probably still very good intentions, probably still maybe meeting a market niche, maybe they're focused on emerging markets, but I do think we're advantaged by the fact that we have a platform, that we have these organizations, that we literally have all this structure, that we have IT, that we use. And so that, I think, helps us score very well on just like process documentation, governance, all of those pieces. And so I want that to be the standard, but I don't want it to be the limit because I do think it advantages large firms. I think this is a little bit of analogy to the ESG controversy. If you look at the ESG indexes and you take a correlation to large cap, the R squared is very high. So really, did you want so much overlap to literally just large cap funds? Because it is the large cap companies that can do all of the disclosures, which for the most part give you good ESG scores. Hence, I think some of the controversy. That's why you have some of these large, for example, oil companies, because if they're doing the reporting and doing the disclosures, they're getting a lot of points for that. But it may be sort of missing some of what we're trying to achieve. So that's a little part of just like, let's not lose the plot when we're doing all of this. We want great practices. We should be developing better definition about what it is, when we're measuring what that looks like, and consistency. And I want comparability. Those things are important. But like, not to forget the plot of what it is we're trying to achieve on driving outcomes and enabling players to really participate in that, because it's a nascent field. I think, people have mentioned GAAP literally started around after the stock market crash in the 1930s, 100 years to develop. You still have new rules and regulations coming out on revenue recognition. It's been evolving over 100 years. So we're still early stages of impact investing. We are getting better, but don't let perfect be the enemy of good.
Yeah, Christina Leunifud is the founder of Blue Market, and she said, "Are you guys going to require people to be verified?" And I said, "Not yet. We can't do that. That's our objective. Right now, we just require that every single one of our fund managers give us the impact metrics that they plan to collect and report back to us." And the reason why we do that, and we do it in a side letter before we let money go out the door, is people would say, "Oh, we just have our impact report." And sometimes you could be a fund manager and have 3 funds. Let's say we invested in fund 3, but not fund 2 and fund 1, and they're just throwing these numbers in there. I'm like, but where's fund 3? Like, how do I attribute our investment? I was like, this doesn't help me. And it's like 80 pages. We want measurable data. There's a lot of new tools out there with folks who are working with fund managers or companies to help them with their impact reporting. Some are really interesting, some are innovative. Some make my head spin. There's people like, I'm going to solve the impact reporting through blockchain, right, for investors. And we still have yet to find that. Now, are there any new tools that you think are valuable, or is there a little bit too much noise out there with everyone creating a tool that they believe is the silver bullet?
Honestly, I would say it's still very nascent. Even we are testing a lot of new tools, and there's promise in a lot, many of these, but it's still a promise. Even we've been using some of what probably in the market are sort of seen as real leaders, but it's still a little bit of a promise. We've been using some of them and testing it with our companies, and they're just, I want to say that they're great and evolving, but it's not that far from, upload the 8 spreadsheets, provide it, and then you get back this nice dashboard. But the vision is for it to be far more API connectivity, so who knows, blockchain and whatnot, but that right now they're still pretty nascent. Right now it's still more of a promise of all that it's going to be. But in the end, it is still reasonably early, and I think a lot dependent on the company capabilities. a lot of things like GHG, you can measure on dollar inputs versus actual units. And so that kind of comes back to the company's capability. Can the company actually provide units versus dollars? Dollars are less precise. But so literally it requires the companies to be on systems that are more precise in order to upload to these new tools and systems. So honestly, I would just still say there's promise in some, clearly more, call it market traction in some, but like even using them, they're not yet all the way there.
You hit on a great word, promises. And an example is we were looking at a new product or solution, and I asked the founder, because they had great investors behind them, like well-intended folks who've been doing impact investing for a long time. I said, so what is this? Is this for ESG? Is this for impact? Yeah. Is this for the company or the fund managers? Yeah. So is it back to folks like ourselves? Yeah, we're doing it all. But I couldn't see anything. And so to me, it was just more noise, and I've had a few of those. And so, as we look into the future, where do you see this industry moving in terms of best practices, in terms of impact reporting, again, with the objective to mitigate impact washing? Where do you see us going?
I definitely see that there will be far more transparency. So I think that's a positive, and more data collection. And then I do think that it'll be supported by innovations through systems that make that reporting and the data collection easier. We're still not there today. There are solutions that we could be using, but they're expensive. And so one of the things, especially coming from our large cap fund to more the middle market space, I am sensitive to this concept for our companies of what I've started to term like an impact tax, that I want to participate in the data convergence project. It is moving in the right direction and trying to provide transparency. It is not a one size fits all, that by having those specific metrics, on the one hand, it is sort of putting aside SASB materiality. Is GHG actually material for every single one of our companies? Our software education company that is remote, it's not material, but we will report it to try to be good citizens as part of the data convergence projects. But for example, injury rate is also another one. But not all of our companies, especially because we're smaller, need to be OSHA compliant yet, that they don't have to report that information. So it's not that hard to get because they're small, but nonetheless, it hasn't even reached the materiality for like OSHA to decide that it's important to measure, and yet, it's part of the reporting. So on the one hand, I think there's going to be a lot more data collection, data transparency, consistency in the metrics. All of these things are muscles that I think will improve the market, but I also think it's a little bit of a pendulum. We might get back more towards materiality that actually, and that's part of how we're trying to evolve some of the, for example, just data convergence that tries to establish, okay, we're going to provide this for you, but it is not material, just to sort of make sure that when we report it to our LPs, that they have this sense of where we're going, which we maybe eventually in the future would, because like that is just one of the, as you probably know, data convergence is one of the data projects. There's actually at least, a dozen others that are, sizable, but many, some of them also sponsored by our LPs, so that I think part of what we're going to try to eventually migrate towards is, again, back to material, what's relevant, because that is what financials are also modeled on. It is historical comparability, but on items that are material. You don't have to report globally if you don't have global operations. You can just report the United States because that's what's material. So essentially, really just evolution on not just one size fits all. I think another aspect that I'm sensitive to is like right now it is also still a little bit some of this regulation around large cap funds. So not things that I think are as relevant to middle market or even venture. But right now, it is like, please provide all of these metrics. So I think what will in the future come is a little bit like context, fit for purpose, as opposed to a little bit more the blunt tool that we have today.
I think that's very helpful. I'm overly optimistic of where we are headed. At the same time, I continue to be concerned. And despite, in my view, venture capital, move away from private equity for a moment, being some of the areas where you actually can invest in some of the most unique and innovative solutions to solve the world's problems in terms of social and environmental, I also, in my view, I believe venture capital is one of the most dangerous when it comes to impact washing. And I'll tell you why. They sometimes invest in 25, 30, 40 companies. It could be a small stake, small investments, and they could put together some really beautiful impact reports. And maybe they highlight 8 of those companies. But there's always, if not always, often there are a few where you're just like, no. I'm going to give some examples and be a little controversial here. Organic booze. A co-working space, a meeting room in an office. So I'm here scratching my head. Can you explain how are you going to report on impact? And the answers on those latter 2 were not there yet. That's the problem. There will always be a little bit of beauty in the eyes of the beholder, but you better report on it. Have a data point for us to make a decision. But when you can't put a data point, ideally an outcome, right? At least an output, you're dusting those things under the rug and you are not an impact investor. Explain this, this meeting room. It helps with stress. I get in the subway here and I get stressed out, right? The co-working space. Explain that. Well, we haven't figured that out yet, but we think it might reduce emissions through transportation. Okay, you're going to have to give me 100 different scenarios and assumptions to prove that. So while I believe some of the most unique investments can be made in venture capital, that is where I get concerned when it comes to impact washing. I don't get as concerned in private equity given its fewer investments, they're larger investments. In many cases, they're big firms, and you guys have to get it right. You have a big reputation risk. So I personally get a little bit less worried about impact washing, but that's my view, despite venture capital being one of the sexiest asset classes out there. So with that, I think we'd love to open it up to questions regarding this topic around impact washing. I see 3 here on the left, 4 in the middle, so maybe start here? Sure, and I see you.
Very brief. We should be already moving forward from the discussion of the trade-off between impact and return, correct?
We should be way past that. Sorry, I answered that. Okay.
I totally agree.
Hi, thank you so much. My name is Olivia. I'm at JP Morgan and feel very lucky to have heard you both speak. So a question for both of you, because you discussed the frameworks that you take into consideration at Bain and the robust nature of those and how you've kind of incorporated those into your analysis. So Mark, a question for you. As the LP, how do you create a framework on your own behalf and use that to be influential to what you're doing, specifically with the rise in demand for co-investments, and as we think about that on a go forward?
I'll go first. So we essentially manage balance sheets for very wealthy people, athletes, folks who've made a lot of money in IPOs and foundations. And so when they tell us we want to build an impact portfolio across asset classes, initially we were getting our fund managers' impact reports. Again, that 40-page report. And could you imagine if they had made 15 impact investments? Are they going to read that? They are not. So we created a software whereby our clients can log in like a financial portal and they can see their real assets portfolio, like a number, a click. So if it's real assets, that can be real affordable housing. That can be climate infrastructure. But they can click around their climate focus and see what are the climate outputs for their venture capital portfolio as well as their real assets portfolio. But it was a very simple software where you could compare apples and oranges, what I mean by asset classes, but still look at some of the outputs regarding social outcomes and outputs, as well as environmental. And so we decided we need to do that on behalf of our clients so that we can get them more comfortable and mobilize more capital into it. For co-investments, this is very different from that. Some of our clients love co-investments because they were founders of very successful companies. But we don't want our partner fund managers to think we're going to compete with them. We see a lot of multifamily offices leading like Series B rounds, and we're like, so what about your partners who are doing Series B? We will never do that. But we love co-investments, but we will do it with our partners. So for example, let's say, I'll use Bain as an example. Let's say we were investing in Bain's venture capital fund. And they said, hey, Caprock, there's a really innovative company out there regarding EV charging, and there's capacity in the deal. Do you guys want to participate? Well, we like that better than us doing it on our own. Why? Because we're going to benefit from their expertise, their due diligence, and hopefully their board seat even. And that's how we can be able to participate in a smart investment on behalf of our clients. We're not going to do it on our own because we want to partner with folks like Bain as an example. I think up there was the third hand I saw go up, and then one in the middle, and then see as well.
Hi, thank you both for your time. My name is Divya. I'm a student at the Columbia Business School. So I wanted to ask, so I like the point that you made about being a market rate investor, and I, of course, understand that Bain Capital has responsibility to its LPs, but I had wondered if increasing employee ownership at the portfolio companies had been part of the conversation, and if being an impact-driven investor means thinking about equity when it comes to returns, or is that not compatible with being a market rate investor?
I would say we've definitely thought about employee ownership and creating employee equity. We did it in one of our large cap investments where we provided equity, but I would just say it wasn't so straightforward, and we're evolving. As I take it to middle market, it's definitely something I'm focused on, like thinking about. However, one of the things that we've been first focusing on before we do that, because all of these things take a lot of investment and execution. So from my large cap experience where we had a large team, it's a lot of time spent investing and educating folks. Actually, it takes me a decent amount of time to explain to our executives, how the equity program works, the value of it. You've got it today, it'll pay out, when we exit, this is how we model that. So in some sense, even with our executives who are sophisticated, financially or could be the CFO, it's an investment. So doing it at the employee level takes even more investment. And one of the things we've been focused on is that the right first step? Is that where we first want to put our dollars? Because that is an investment of dollars, because that is part of total compensation. And so our focus first has been on, because we're in the middle markets, living wages, PTO days, benefits that are affordable, so that I definitely want to get to employee equity, but our companies don't start from a place where I think that things that are valued more, just valued more by the front line are in place. We don't have, for example, 401k plans all the time. So we are in the process of trying to get all of our companies to 100% living wage, to get to PTO days, because that is actually, when we survey our companies, one of the things that are very much valued. So before I offer something that is actually not feeding the family, not really helping them to live a better life today, I want to make sure I get to sort of like, in some sense, that Maslow's hierarchy of needs. That is definitely in my aspiration, but I'm not there yet with my companies.
It's a great question. We have a foundation client where that's very, very important. Appreciate it. I want to say someone was very patient up here in the middle, unless the hand is, oh, there you go, right there.
Hi, I'm Layla. I'm a sustainability management student. Thank you so much for your time to be here. I was wondering what your screening and evaluation process looked like when it comes to impact washing. Like, how did you especially for, I guess, the earlier stage ventures?
Maybe I'll take that. And we're not screening it. We're investing in funds like Bain, and we invest in numerous venture capital funds. And I think, as I mentioned, is we require all of our venture capital funds, anything from seed to Series D, report back to us on a regular cadence the impact within the portfolio. And we want to see that at every company. Still not there yet. Sometimes we only get 5 to 7, but it is a requirement that we do before our money goes out the door. And I will say we are an anomaly. I would think most family offices and institutional investors, they're not demanding that yet. I'm hopeful that more do it. But we require a side letter. I saw one question here, and I think it might be our last or second to last. It might be our last. It's on its.
Hi, this is.
Okay, we could have one more after that. Thank you. It's going to go to him right next. Yep.
Oh.
Go ahead.
This is Rebecca, CBS 24. I worked in venture capital before and then later PE. My question is, ESG impact investment has become such a trend. And when it comes to fundraising to family offices, LPs like you, everybody try to claim they're impactful, they have the ESG pillar. How do you distinguish that? How do you measure and guide them in terms of like investing in venture capitals and PEs?
Is that for you?
I think it's for you.
Is that for me, or is it, I think.
Selecting impact venture funds.
Yeah, okay, I wasn't sure if we're talking about fundraising, when groups like Bain are going out to market to institutional investors for fundraising. They've been very successful at doing so. It's interesting. We look at track record, which is tough when someone is doing their first fund. Obviously, a group like Bain has been doing private equity longer than almost anybody, but often there's founders, there's friends who would work in different capacities, create their own venture capital fund for impact. We're seeing more and more by the day. Now, will we back a first-time fund manager is what we call it, meaning a group that's worked together. Maybe one was a VC somewhere and another VC somewhere else. That's great, but you want to see them work together because more often than not, you see something called an implosion. When that implosion hits, there's called a key person risk. When that key person event happens, they can no longer invest. It stops and investors just start to lose money. So we go back to this track record. How have these folks worked together historically? Are they smart investors? Have they exited? Now that's harder when you're launching your first or second fund. It's easier when you get to fund 3. But within that, how are they producing their impact data? How intertwined is it in every investment that they make? Something we look at. We want to look at their framework. Just like when we selected Bain over all the other PE firms out there, what really got us over the end there, the high bar, besides a dedicated team, a full-blown team, was their very intentional impact framework. One last question right here has been incredibly patient.
Am I audible? Yeah. So between the both of you, I'm sure you represent a diversified list of clients. And I'm curious to understand how different is the impact priorities between institutional investors and individual investors. Because the institutional investors have the benefit of a full-fledged team internally who can think about ESG and think about the expectations and then probably pass those expectations on to the GPs to sort of implement them, whereas the individual investors may not have those resources. So do you sort of have these challenges balancing out impact priorities between institutional investors and individual investors?
I would say that fundamentally, we're transparent in what our strategy, reporting, approach is during fundraising. And so folks that have chosen to invest with us are pretty aligned. And so we don't find that we have any conflict, because if they only wanted to be a single target social fund, we were not the fund for them to begin with. And so I think that literally the fundraising diligence process is fairly thorough, as the questions that we get, the approach, et cetera, helps to ensure that we have the alignment of our investing LPs.
Often individuals they hire folks like us to do it on their behalf when making those investments. But many cases, there's the friends and family that help out in those first cases. And by doing that, you can get around minimums that people require, like being a qualified purchaser. That's a level of net assets, or accredited investor, or even a minimum investment. One thing we're able to do is, because it's not easy to access a Bain fund, we'll often ask for a lower minimum for our families, and we will aggregate those so that we can invest in a Bain on behalf of maybe 5 or 10 families. That's something we try to do so folks can participate in things. The definition of institutional investor, I find, gets slightly misconstrued often when people are like, we've just got our first institutional investor. And I look and I was like, that's not what I would consider institutional investor. But it often depends on the stage and the amount of money someone can invest and the accreditation. Hopefully there's more opportunities in the future with easier access. And I think a lot of people are trying to make that happen. It'll take some time. Well, thank you all very much for your great questions and listening, and a huge thank you to Cecilia Chao from Bain Capital for coming all the way down from Boston for this session. We really, really appreciate everyone's time, particularly Cecilia's.
Thank you, guys.